So Theo, it's beginning of 2018, and I think the topic of conversation around our country at the moment is the politics, and then linked to that is the rand.
Yes, the rand has strengthened tremendously specifically since the beginning of December. Now, what we have to keep in mind is it looks like the rand is a lot stronger than it was last 2 or 3 years, but that's not the case. If you look over the past 10 years when Zuma was in charge, and you look at a graph of the rand and you put the price parity in there, that means the difference between our inflation and the US inflation. Now that is the buying power of the rand should weaken at that level for the 10-year period, just to stay at the same purchasing power level. If you do that, the rand's not strong, the rand is just less weak. It almost came back into the long-term band again, but is not near the level of that band. If it wants to get to the purchase parity where it was 10 years ago, the average over this period, it should actually be closer to 11. And I come back to the point, it's not that the rand is strong, the rand is less weak. On an exchange rate basis, the rand is now where it was against the Aussie dollar 5 years ago. What does that mean? That means we moved in the same level because we were driven by commodity prices, and the role of politics is almost eroding out of the rand. The Zuma discount is starting to disappear. Now we're back as a commodity country competing with other commodity exchanges. On a lighter note, if you take the Big Mac index, our average over the past 5 years or 10 years is that we're roughly 40% undervalued. Currently, we're still more than 50% undervalued against the Big Mac index. We and the Russian ruble are the weakest. So that also shows you that it's not a question of the rand getting strong. It's a question of the rand less weak than it was under the latter part of the Zuma era. And I do believe that if everything goes well, we will get to a period where this idea of South Africa falling off the cliff might be going away, and we might talk about economics, not great, but we might talk about economics and the prospect for growth and that things. But Warren, having said that, where does that leave investors? How do you frame your decision?
So if you look at the rand and you're just trying to decide when to send your money out of the country, and you look at the rand versus the dollar, our level has always been about 13.50 to the dollar. And if we think about January last year, that was quite a difficult time to convince investors not to send their money out. And the rand was at 16 or 17 to the dollar, and we were saying, don't send your money out. The rand will get better. It wasn't a prediction or a forecast about what was going to happen. We just knew that the rand at that time was particularly cheap. And if we look at what's happening now, the rand's at somewhere around 12 or even stronger. Now it's become quite a difficult time to say to investors, now's the time to actually send your money out, because as South Africans, we're quite optimistic. So what we're saying is, let's take our money and wait for the rand to get even stronger. It might get to 10 or something like that, and then let's send it out. And the problem is, we don't know what's going to happen next week or next month or next year. It could actually just go much weaker very quickly if something goes wrong. So what we would be saying there is, this is the time to buy your international exposure because it fits into your financial position. It's not a trading opportunity about what we think is going to happen in the next 3 months. It's about building your long-term structural allocation.
The more important question is therefore, what level of overseas exposure should you have? Because if you're underweight on that, this creates a great opportunity to get your weighting to where it should be, and not the other way around.
So I think every investor over time needs to have a minimum of 25% of their assets out of South Africa. And that's not a call on being pessimistic about the country, that's just rational diversification. For families that have excess capital, in other words, where it's mom and dad and they know they're going to leave some money behind to their kids, that should start to increase to about 50% of their investment assets. And then for families where they know they're going to have money going to grandchildren or the third or fourth generation, that could go as high as 75% of their assets. And that's quite a nice benchmark for investors to say, okay, if I've got nothing overseas, then I need to start. Whereas if you've got a bit, but you know you've got enough money to leave behind to at least one generation, push it up. And if you're in that fortunate position where you're in a very wealthy family, keep going and keep building up your offshore assets. 25% exposure to one country is still a heck of a big exposure to any emerging market.